Now, I have collected a lot of different rent growth numbers. Now, the national rent growth number for Yardi Matrix, their projection for 2022 is 4.8. And then I'll just run down really quick. There's about 6 or so other reports that I also have kind of collated and gathered. So Yardi Matrix has 4.8 for their 2022 projection.
4.8% rent growth, annualized rent growth for 2022.
Fannie Mae has 4 to 5%. Freddie Mac is on the low end, actually, with 3.6%. Marcus and Millichap, 5.2%. Berkadia, 5.9%. CoStar, 7%. And RealPage is on the higher end at 8% rent growth. And the average of all of these, my Nate Silver average, is 5.57%.
Why don't we have our own index, Matt?
That's a very good point.
I mean, I haven't seen any sources aggregating and providing an actual average. So stay tuned to the Gray Report.
Get a good rolling average.
Because we'll have a nice rolling average. Because I think that is important. And, what I think is interesting, again, is where these sources are coming from. Most of these are from brokerage firms and lenders. CoStar is obviously, so Yardi Matrix, they're a property management software firm, data analytics firm as well. Fannie Mae and Freddie Mac, obviously, these are government-sponsored entities that are, the biggest lenders of multifamily assets. Those are and then the rest are RealPage, also data and property management. But Fannie and Freddie is interesting because, that's obviously they're doing most multifamily loans. They're having to do their own underwriting, issuing new debt for these projects. And so when a purchaser of an apartment community, goes to Fannie or Freddie with their projections, I'm assuming that their underwriters and their originators are going to be going to their own projections of rent growth. To try to
very good point.
Dial in.
And
they're in general being a little more conservative, and that is representative of really the attitude for most lenders over the past since the great financial crisis. Of much tighter lending standards, even for deals that we know we should be able to get higher leverage. Oftentimes, and we speak to a lot of different lenders. Really, in the past year, we've been limited by how much they are willing to lend because they are very cautious. And so I think that is further expressed in maybe their lower, just slightly more conservative.
Now, this is another thing that I was kind of like, I was thinking about it a lot as I gathered these numbers, because we did a similar exercise last year, and I kind of looked at how wrong were they? They predicted a fairly modest, relatively modest growth, much more modest than it ended up being. So if they were so wrong, if they were so wrong, then why trust these new predictions? They got it wrong last year. So what makes them be so right this year? I think it's because in 2020, honestly, anyone that was following the multifamily markets, the economy, what have you, it was so uncertain. Uncertainty was the byword, and that was, we were saying it and repeating it every other week, it seems like. It's hard to believe now, and I've mentioned this, a time when people were waiting and seeing in 2020, if you can remember that. And so by the end of 2020 and the start of 2021, yes, vaccines were starting to roll out, but the economy wasn't completely on sure footing. So there was not as much coherent data, I think, to make as sound of a projection. And I think, honestly, it's much more stable or much more predictable. If you look back at 2021, there's a lot more information that we had that wasn't volatility. It was breakneck growth. But we know, I think, a whole lot more consistent trends like rising inflation. And that may not be great on people's pocketbooks. But I also think that the fact that these industry experts are not just continuing the growth, they're not just plotting it and, continuing the slope, they're kind of moderating things. I think that's compelling enough at least to warrant consideration and think, okay, so why do they think that these trend lines are not going to continue? And I don't think it's a general tendency to be more modest because there's, they want to get it right.
They want to get it close. I think that they're more concerned about overshooting than undershooting, though. And
that's a good point.
I think a lot of it, just looking at, we have a CoStar account and are looking at CoStar all the time, and a lot of they provide a forecast a couple years into the future, couple different models, And a lot of their forecasts really seems to be just based on a reversion to the mean,
Yeah.
which I think to a certain degree certainly, makes sense. But, as time goes on, that mean it increases,
Yeah.
higher and higher. And I think they're just going back to statistics because we don't know. So let's just revert back to math, and
Yeah.
we're going to revert to the mean.
And
to
that
some
may
degree.
be like almost the exact opposite of seeing the forest for the tree, or of being too hyper focused.
Yeah.
That leads to volatility on like a day trader. But for a long term trader, you have to maybe fight that urge to just follow that.
Well, and
trend
these
line.
are asymmetric events we're talking
Yeah.
about. It's not the same things happening, and so we can predict. I mean, whether it's these supply shortages or new outbreak or whatever it might be. We don't have the inputs.
Yeah. Well, and that's why I trust this year. By the end of 2021 and the start of 2022, I trust this data a little bit more than it was unprecedented times. It was these unprecedented times in 2021. There's a lot more precedent now at the end of 20.
That's true.
At the end of this
New
year,
variant comes. Now we've seen a handful.
more
What to
precedented.
expect.
Yeah.
I agree.